by making that one change, we now can use our own banking system instead of somebody else's banking system. By putting our money in here, we're taking advantage of uninterrupted compounding interest. Again, it's tax-free and it's guaranteed. While the money's in there compounding, we can take it out, invest it, and grow our wealth, keep the money moving and making more money for us. It's because you're in complete control. This is your banking system. All right. Hey, welcome to the Wealth Webinar. I'm Stephen Nagy. I am hosting today on behalf of Chris Naugle. Chris is out traveling at an event. So what we're going to do today is we're going to dig into the infinite banking concept and what we call becoming your own bank. So we're going to talk a little bit about everything today. So I'm super excited to spend this time with you. And I want to make this interactive. So just real fast in the chat box, who here has money and you're looking for ways to use that money to make more money? Just write money in the chat box real fast. If you have money and you're looking for ways to make more money, or if maybe you need money, maybe you have some opportunities, maybe those are real estate deals, real estate investments, maybe something with your business, but you need money to be able to make those things happen. Put deal in the chat box. Put deal if you're looking for new money to help you do more deals and things like that. Because that's exactly what we're going to talk about today is both of those. And then, how many of you on here right now are looking, whether you have money or you're making money, you're looking to be very smart with that money and keep more of that money that you are making, right? Keep in the chat box. If you want to keep more of your hard-earned dollars within your financial life, and not only keep it, but grow it uninterrupted for the rest of your life by making one change. Who wants to learn how to make one change and create uninterrupted compounding interest on all of your money from this point moving forward? Right? Let's see, right? Compound. All right, we're going to talk about compounding interest today also, all right? So what we're really going to focus on are a few different things. And I like to open this up. How many of you would like to become the bank? And what does becoming the bank look like? Well, what if I could show you how to create a banking system over the next hour right now? And that banking system comes with an ATM machine. And down the road, you can use that ATM machine starting tomorrow. You can start pulling money out of that ATM machine. But this is a really cool ATM machine because a few years down the road, you're going to be able to go put, let's say, $10,000 into that ATM machine. And the very next day, you'll be able to pull out $12,000. And then the next year, you go put $10,000 in that ATM machine. And the next day, you can pull out $14,000. And the next year, you put $10,000 in that ATM machine. And the next day, you can pull $17,000 out. And the next year, you put $10,000 in. And the next day, you can pull $19,000. How many of you would not only want a banking system, become your own bank, but want one of those ATM machines? Put ATM in the chat box if you want one of those ATM machines. And then what if I told you that not only could you only have one of those ATM machines, but how many of you would want a bunch of those ATM machines in your banking system? Absolutely, right? So that's exactly what I'm going to show you right now over the next hour or so, is how to create this banking system, keep more of the dollars that you make and be able to go and pull more money out every single year for the rest of your life with this ATM machine. All right, cool. All right. So I see a lot of good stuff happening in the chat box. So like I said, we're going to keep this active. So Shauna's on there helping kind of manage stuff in the chat. If you have questions, put them in the Q&A section because the chat goes fast. I can't keep up with it. So put the questions in the Q&A section and I'll make sure to hit those questions either as we go if they're relevant, or at the end, we'll hit all of them, all right? So with that being said, let's go ahead and dive into this a little bit. How to become the bank. And this is what we call the money multiplier or the infinite banking concept. Now, just real fast, this is all my contact information. We'll give this to you guys, so you don't have to write it down right now. But and just for being on here, we're going to get you some additional resources, some digital books and things like that. So I'll make sure you have the links to get all that stuff. But just want all of you to know, I keep my cell phone on me 24/7. I don't always respond right away, but I will respond to text messages, to emails. So follow along if I can ever be of any help whatsoever. please reach out to me. That's why we're here. This is what I do with the Money Multiplier, with Money School, with BYOB, with Chris Naugle, with Sean. This is all we do all day, every day, 7 days a week, and we love it. So anything we can do to help you guys out, that's why we are here. So one of the things that you're definitely going to want to do is get access to our resources. And the reason I say that is because Chris and I put on 4, 5, 6, 7, 8 webinars for free every single week. And what we do on these webinars is we dive in deep on what's going on with the markets, what's going on with policy decisions, what's going on with your money, and how is all of this creating opportunities? What should we be doing right now? I got to tell you, in the world that we live in right now, things happen fast. Man, things are happening quick. And all of a sudden, everything's looking good. And the next day we see a huge downturn. And then all of a sudden markets are running again. And then all of a sudden some new news comes out or a policy decision and wham, everything sinks again. So things happen very, very quick. So we want to keep up with that. We want to keep up with what is the Fed doing? What is inflation doing? What is the federal government doing? What is the Federal Reserve doing? What is happening out there in the world? This is the stuff we study. We study white papers. We read these books. Why? Because again, this is what we do all day, every day. And then it allows you to hop on a webinar once or twice a week for an hour and learn what's happening. What should you be doing with your money to take full advantage of these opportunities? I honestly believe that over the next 12 to 18 months, we're going to see a lot of changes happening, not only in the United States with our economy, but also in the world, the global economy. And I honestly believe that it's going to create incredible opportunities for those of you that know what you're doing, for those of you that are prepared and ready to take advantage of it. How many of you remember 2008 housing collapse? Maybe some of you got caught up in it. Maybe some of you were investing at the time. But how many of you after 2008, let's say 2010, 2011, 2012, 2013, how many of you were ready and prepared and went out there and bought a bunch of real estate? Was anybody on there, right? Real estate. If you were buying real estate back in like 2010, 11, 12, 13. If you were, I guarantee you, you're in a much better financial position today than you were in 2008. Why? Because real estate's seen an crazy appreciation increases. And so people have been able to ride that appreciation while having nice, consistent cash flow the entire time. And now what's going on is we're selling out. We're selling the properties at the market high. Warren Buffett says it best. What does Warren Buffett say the 3 rules to investing are? What are the 3 rules to investing? You guys put them in the chat box. I know you know this. Chris talks about it all the time. Yep, Leo, that's one of the rules. Buy low, sell high, and don't lose money. And, it goes back when I used to teach a lot of real estate investing. When I was doing a lot of real estate investing, I would teach it. And one of the things that I would always bring up in real estate investing is I would ask the question, in real estate, do you make money when you buy or when you sell? And everybody would say, when you sell. But think about it. You actually make money when you buy. You realize the profits when you sell, but that deal is had up front when you buy. Because if you can buy something at a deal, at a bargain, at a discount low enough, and you can do forced appreciation or ride a market appreciation up or whatever, if we buy it low enough, no matter what else happens, we're going to be able to cash out much higher. So we're buying low and selling high, and we're never going to lose money that way. And that's what I think is going to happen with these markets coming up is we're going to see a pullback. We're going to see incredible opportunities. We're going to see a lot of people that are financially hurt, losing properties, distressed properties, disaster, all the things that happen with real estate. There's gonna be so much opportunity where we can buy low again. Right now, we're at the top of the market. So unless you have an established real estate business, it's sometimes hard to find those deals down here right now. But the market's gonna take care of that for us. And those of us that are ready over the next 12, 18, 24 months, we're gonna be ready to buy low and just run this cycle through again. That's why we're selling right now at the top of the market. We're cashing out. We're putting our money in a short-term private money loans, private funds, things of that nature where we can control our money short term. And then we're getting ready for this next correction. So what can we do at that point? We can go in and we can buy again. It's just the principles. And if you're disciplined to follow this and disciplined to get the education and learn it right now, you'll be prepared and you and your family will be in a much better position. So what I'm going to talk about today is more the infinite banking concept and what you can start doing with your money today to prepare for what's coming down the road. And then if you want to learn really how to get into real estate investing, we have some incredible opportunities I'll talk about at the end with you on how you can start learning and getting into real estate investing now, so you're prepared when all of this stuff happens over the next 12, 18, 24 months, maybe sooner. Nobody can time the markets and when it all happens. But the bottom line is we can be ready for it and prepared for it no matter what happens. So that's exactly what I'm talking about. So hop on our weekly webinars, get around what we call this campfire, and it'll truly change your financial life. I mean, I guarantee you there's people on right now. Maybe you can share your story in the chat box while I'm going right now, just kind of what you've learned over the last several years from money school and the money multiplier and how it's affected your life already. And this is during normal time. Imagine once we have these opportunities that are coming up. So I'm just super pumped for this stuff, guys, if you can't tell. All right, so the 5%, why do we talk about the 5% all the time? Well, in a former life, years ago, out of college, I was a personal financial advisor. So I had all the fancy licenses, Series 7, Series 66, 215 variable annuity, all the certificates and all that stuff. And I was a financial advisor with Ameriprise Financial. And so my job would be to sit down with clients and talk to them about their hopes, their dreams, what does retirement look like? And then it was my job to help them create a plan. And so I saw this firsthand as a financial advisor that very, very few people in this country right now are prepared and on track to retire the lifestyle and the age and how they want to. It's just not happening. And then over the last over decade now of traveling the country and working with people all around the United States of America, one-on-one and in group settings, I've really seen that, it's really 5% of people that take things serious. If you have a group of 100 people, it's always going to be about 5% of those people that it's usually going to be about 10% of people that actually take action, but only about half of those people are actually going to follow through and make things happen. So if I have a group of 100 people, I don't know how many I have on here right now. Let me see. It's just over 100 people on here right now. So statistics tell me that out of this group of 100 people, about 10 of you will actually take action on something that you learn, and only about 5 of you actually follow through and become successful with it. That's just statistics. Now we can change it to fit, to make it better. And the way we do that is through advertising, through marketing. We invite people to these wealth webinars that are already interested in financial education, that are already investing in things like real estate. So now out of the group of 100 people on here, you might be, already part of that 5%. So that tells me that out of the 100 people on here, a lot more people are going to be able to take action and be successful with this information because you already have the right mindset. So much of what we teach is mindset. And the Social Security Administration tells us this exact same thing. If you take 100 people at retirement age, only 5 out of 100 are going to be financially secure. And I'm not even talking about financially successful, just financially secure, where the other 95 out of 100 people are going to have to go back to work, push back retirement, or drastically change what that retirement looks like for them in their lives. And then why does that happen? And really, I boiled it down to 3 or 4 different, what I call wealth killers. Okay, so number one, these are all things that just erode wealth from your life. Remember before, I said I'm going to show you how to keep more of the dollars that you earn. And these are things that take those dollars away from us. And so we need to start right now today eliminating as many of these wealth killers as possible to put us in the best possible position moving forward to keep more of our dollars. Why would we want to keep more of our dollars? Well, yeah, we can start saving them, but more importantly, we can take those dollars and we can put those dollars to work, making more dollars for us. And at the end of the day, not only if we can keep more of our dollars, but if our dollars can go make more dollars for us, that's a game changer right there, baby. And that's what this is all about. So these wealth killers, we're going to start eliminating. In fact, what I'm teaching you right now today, everything you're going to put your money into this banking system, inside of it, it's all tax-free growth. When we use the money, it's tax-free coming out. The profits, you're going to be taxed, but we have strategies we follow. We have tax planning and tax strategizing that you need to start learning. You're going to do things like start a company, an LLC. So now we start writing things off. We can look at, when we get to a certain income level, start looking at things like 1041 tax reporting. Did any of you guys catch Solomon Halamani last week on the wealth webinar last Wednesday? So things like that. So we can start eliminating these taxes from our life, keeping more of our hard-earned dollars and taking those dollars. And if we want to help help other people with them, like taxes are designed to do, even though there's a lot of waste in taxes, federal and state taxes. But if we want to really help people, then we can take those dollars and we can actually start giving them to charities and giving them to families and people in our community that can really use them. Inflation, wealth killer number 2. Everybody's heard of inflation the last couple of years. It's been huge. If we look at real inflation over the last couple of years, we're almost pushing like 20%, meaning what the dollar was worth 2 years ago, that same dollar will buy you about 20% less today. And we all feel it in the grocery stores and at the gas pumps and going out to eat and everything else that we spend money on. So that one's become really in our face over the last couple of years. So how do we start eliminating inflation for our life? Well, unfortunately, we can't control what the federal government does. We can't control or spends their money on. We can't control how the Fed prints money and everything they're doing with monetary policy right now. But we can be smart with our dollars, keep those dollars moving and making more dollars where it keeps up with inflation and basically eliminates it from our financial lives. Volatility, that's what I was talking about earlier with the ups and downs, the market being at all-time high right now. Why ride that thing back down? Why not sell high? Why not be smart with what we're doing? Why not put our money into guaranteed vehicles, put our money into things that we can control that create predictable, consistent returns, regardless of what the market's doing? See, the reason I never loved the stock market, even as a financial advisor, where that's what was my playground, was the stock market. I never loved it. I never truly believed in it. Why? Because you give up complete control. You invest in a company, you don't have control on what that CEO is doing. We see it all the time with these companies. They end up getting in trouble for stealing customer money or doing illegal things, and then the stock just takes a dump. Like all this stuff we can't control. So then what we do is we look at, okay, well, let's diversify our money, diversify into, indexes and all these different companies. Well, the S&P 500, there's 7 companies that are giving the S&P a positive return this year. 493 companies are losing money. So diversification works, but why are we losing with those 493 when we can just get out of that and control our money? So that's what a lot of this is about, is control. And then of course, interest. I'm going to show you in a second how much money gets bled out of your financial life through interest to outside third parties. It's mind blowing. So what if we could keep that interest that's bleeding out to everybody else within our financial life? And that's the beautiful thing about the infinite banking concept and what that allows us to do. And then of course, when it comes to why aren't more people successful, a lot of times it's just mindset. We get into our own minds, or we let our friends or family members influence what we're doing, or we just do what's always been done. Why? Because it's always been done. Have you ever heard, I think it was Einstein said, the definition of insanity is doing the same thing over and over again, expecting different results. Well, if almost everybody invests in their 401k and plan on using that for retirement, but 95% of people can't retire with that strategy, why do we just keep blindly throwing money in these 401ks? Why do people, when they get out of college, start new jobs, just say, go to the HR department and they say, you want to start your 401k? And the kid's like, well, I guess so. Everybody else does it. Why are we doing this stuff? Following the status quo, doing what everybody else has been done. What I'm teaching you right now is not even what the 5% are doing. It's what the 2% are doing. But if you are willing to follow this strategy right now, it's going to completely change. It's a game changer. It's going to change your entire financial future. And you might have family members, friends that tell you, hey, that's crazy. Dave Ramsey says you can't do this stuff. Well, you know what? Go follow him then, Don't do what the wealthy do. Don't do what the successful people do. But same thing with real estate investing. I mean, how many of you in real estate right now, when you first started in real estate, you went and told your spouse or a family member, your parents, kids, whatever, you said, hey, you know what? I took this real estate course. I'm going to start flipping houses. I'm going to start buying rental properties. I'm going to be a real estate investor. What did they say to you? I guarantee you, a lot of you on here, they looked at you and said, you can't do that. What makes you think you can be like those people on TV that flip all those houses? Yeah, Mary, you're nuts. Will said, it's not going to work, and we see this stuff all the time. I've heard it too. And we talk about it all the time. So it's just things like that. Fear is an easy one. Fear is just understanding. The reason people have fear, regardless of what it is, it's just not knowing what's next, not knowing what that path looks like. I mean, if you're in an airplane about to jump out of an airplane and you've never jumped out of an airplane, you know nothing about it, you just like, and somebody hands you a backpack and they're like, here, take this backpack and jump, you'll be fine. You're going to be scared to death. But if you've been trained how to use that backpack, which is a parachute, and you know exactly what to do when you jump out of the plane with it, are you going to be scared? No, you're going to be excited. Why? Because it's fun. And we could talk about that with shark diving, with scuba diving, with skiing, with anything out there in the world. It includes investing. It includes doing something different. If we're fearful because we don't understand it, it's going to stop us from doing it. So if we can just have some education and some understanding, that fear is going to creep away. The best way to do it is to do it. And that's exactly why we're here, to hold your hand, to take that fear away so you'll take that leap. Because I guarantee you, whether it's starting your first banking policy, whether it's flipping your first house, whether it's buying your first investment property, whether it's doing your first private money loan, whether it's starting your first business, once you do it one time, you're going to be able to go out there and do it time and time and time and time and time again. So I challenge all of you, whatever you've been scared of, whatever you've been fearful about, go do it one time and then come talk to me. And if you need help handholding to do it that one time, ask. You're going to pay one way or the other. I've seen it happen probably a million times at this point. You're either going to go out there, make mistakes and lose money, no matter what you do, business, real estate, whatever, or you're going to pay a mentor, pay a coach, pay somebody to help you, partner with somebody to help you, and you're going to do it the right way. But either way, you're going to pay. Would you rather do it the slow way or would you rather do it the fast way? Either way, you're paying. It's up to you. And that's like that with anything in life. One of the reasons why I love Chris, this picture is a little bit older now. This quote I keep up here because when I first met Chris, this was one of the first things I saw on his presentation that he had. And it says, it's never about your actual resources. It's about how resourceful you can be. So think about that for just a second. It's never about your actual resources. It's about how resourceful you can be. Because when I was asking earlier on this chat box, how many of you have money, looking to make more money, and how many of you need money to make more money, it was a pretty good mixture of both. And that's the whole point, is it doesn't matter. You can have millions of dollars in the bank right now and be super successful, or you can be barely getting by, tens of thousands of dollars in debt, living paycheck to paycheck. Both of you can still have a money problem, can still have a challenge ahead of you. I guarantee it. I see it every single day. It's a different challenge. It's a different money problem, but it's a problem. And the solution for it might be a little bit different, but that same solution can apply for both people. And that's why it doesn't matter. It's about the education. It's about how resourceful you can be, no matter what side of the coin that you're on. And that's why I will always leave this quote on here. And that's why I will always be Chris Naugle's friend and business partner, because he's an amazing person. And I've also been introduced to this quote. The problem in America isn't so much what people don't know. It's what people think they know that just ain't so. And that just goes back to what I was talking about before. So many people think that they know everything. I was guilty of this. In 2019, when I first met Chris and I heard the money multiplier presentation, I honestly thought it was gimmicky. Like I thought it was like, I was a financial advisor. Like I thought I knew everything. I've been investing in real estate for over 10 years. I've bought and sold multiple businesses. I thought I knew everything about these different strategies that the wealthy use, these different tax techniques, these different investment techniques. I thought I knew it all. Like I really, really did. I did not think that you could do what Chris was teaching using this to create a banking system. And so I blew it off. I kind of was like, whatever, like I'll learn more about it one day, but for now I don't have time to learn about it. And because of, just like this quote says right here. And then when 2020 came and COVID hit, I had time. And we made a pivot in the business that kind of got me more involved on the infinite banking side of things when it comes to being your own bank, more on that side as opposed to just the real estate side of the business. And so in 2020, at the beginning of 2020, I really started to dig in and learn everything there is to know about the infinite banking concept and what we do with these banking policies. And that's what I do with everything. If I want to learn about something, I dive in deep and I try and learn everything. And not only do I learn about it, but then what I do what all successful people do when they learn something new, they apply it. That's the most important part. You learn it and you apply it. And that's what I did. I learned everything there was and I applied it immediately. Now, I shouldn't say I learned everything because I still learn new strategies and new ways to use infinite banking to this day, 4 years later. But I learned enough to feel comfortable to start my first policy at the beginning of 2020. Now I have 4 of them and we're working on our 5th one later this year. And like I said, I learn new stuff all the time. So just because you think you know something doesn't necessarily mean that it's not only the only way, but it's the right way. It's the best way. There could be something better out there. So keep your mind open, because what we teach you with the infinite banking concept, it's literally going to flip your head. But as soon as that happens, guess what? You're going to get it. And now you're never going to turn around. Once you learn how to become your own bank, you're never going to go back to using other people's banks. I promise you that. I guarantee you that. All right, let's roll. A couple things, if you're new to this, write this down. I don't have time to play this video, but after we're done today, go on YouTube and type in the backwards bicycle and get out a notepad if you don't already, because I'm going to tell you some things today you got to go do after the webinar. Things that you're going to want to do. So write this stuff down. So write down the backwards bicycle, go on YouTube, go watch it. And it's a great example of what I was saying with that mindset shift, because what they do is they take a bicycle, they take the handlebars and they reverse the way they work. And guess what happens? Nobody can ride the bicycle. It's crazy. Like all of you on here, I guarantee you know how to ride bicycles, right? Ride a bicycle. By making that one change, how the handlebars operate, there's no way you can ride the bike anymore. And in this video, they do all kinds of demos and examples, and then they get into the mind science behind it and why it happens. People a lot smarter than I explain that, but it's fascinating. And that's exactly like this concept. People bank a certain way their entire lives. They fight against doing it, but once they learn it, boom. Because once you learn how to ride the backwards bicycle, the backwards handlebars, you can do it again. You just got to retrain your mind on what that looks like. So the way you're going to do that is not only through a 90-minute presentation today, but it's through getting around our campfire, the weekly webinars that we do, through books, through audiobooks, through reading. So here's a few books. Write these down real fast. Anything by Robert Kiyosaki. I'm a huge fan of Kiyosaki. He's one of the main forces and mentors I had when I was leaving my financial advisor career to become a business owner and investor. A lot of what I learned was through his cash flow quadrant, the 4 quadrants, the way to look at assets versus liabilities. And I would start to apply that into my own life. And it's mind blowing what happens when you start changing that. And so what I'm teaching you today with the infinite banking concept, Kiyosaki talks all about in that book, Second Chance, right there. So check it out. Tony Robbins. If you need a mindset shift, please attend Tony Robbins events, check him out, read his books, amazing for mindset. He talks all about the infinite banking concept in this book right here, Money Master the Game. R. Nelson Nash, Becoming Your Own Banker. This is like our Bible when it comes to the infinite banking concept. R. Nelson Nash was like the godfather of bringing this stuff to the masses and really creating it. See, what I'm teaching you right now today on this Wednesday in August of 2023 is not new. This is not something that I even invented. It's been used for over 200 years and really came into mainstream back in like the 80s and 90s because of R. Nelson Nash. And what we've done here at the Money Multiplier and Money School BYOB with Chris is we've just taken it to a whole new level. What we do now, I think Nelson Nash would look at what we do now and just be like, you guys are amazing. Like what you're doing, you've taken what I used to teach to a whole new level. And so we give him all the credit in the world. That's an incredible book. Definitely get a copy of it, read through it, listen to it, whatever you do, but it's a must read. Mapping Out the Millionaire Mystery is kind of an updated version of Becoming Your Own Banker that Brent and Chris wrote. And then the Private Money Guide, Real Estate Investing. If you're looking to get into real estate private lending or borrowing, it's a great foundation with some basics on how private money works. An incredible book for keeping money moving and making more money. So those 2 bottom books right there, along with Drifting Away from Traditional Car Buying, you should already have digital copies of those for free for registering for today's webinar. If not, at the end, I'll give you the link that you can download those books for free if you don't already have them. So again, this is me. I'm Stephen Nagy. Like I said, I live down in South Florida in the Jupiter area, Jupiter, Florida, over on the East Coast, Palm Beach County. Been doing this for almost 15 years now. Owned and operated many businesses. And just in the last 4 years, I've personally helped over 1,000 other people start their own banking systems personally. Our company's probably over $5,000 by now over the last 5 years, 5,000, but me personally over 1,000. So very proud of that, and love hopping on today to keep talking about this stuff. Mary said Sharon Lecter wrote with Kiyosaki. Yeah, Sharon's awesome. I had lunch with Sharon about 1.5 years ago. And then Kiyosaki's wife, Kim, is actually going to be, Kim will be at the mastermind that Chris, Sean, and myself will be at in Tampa next month. So look forward to seeing Kim. I haven't seen her in over a decade. I'm sure she doesn't remember me anymore, but Kim's an awesome lady too. So look forward to seeing them. So what is the money multiplier method? And the way I'm going to teach this to you here today is we're going to teach it in 3 different sections. So number 1, we're going to talk about the machine. Number 2, we're going to talk about the marathon. So the machine is the vehicle used to build this banking system. The marathon is the most important part. The marathon is the process or the concept of how we use that machine to create this perpetual tailwind and eliminate things like inflation and everything else from our financial lives and interest and all of that. So the marathon is the most important part. And what I'm going to do with the marathon is I'm going to show you 3 different examples. And I use these 3 examples because what I found is these are the 3 most popular ways that people use the infinite banking concept in this machine when they first start, when you're first kind of learning the basics. And by learning as you do, it'll allow you to do more and more down the road and learn more of the advanced stuff. So I'm going to give you several different examples of the marathon. And then the third and final part of this is the millionaire, which is usually everybody's favorite topic to talk about. But this is just how, if you use this machine properly and you follow the marathon, the process and the concept, how almost irregardless of anything else that you do, it'll create the millionaire for your financial life. So we're going to talk about that too. All right. So what is the machine? Well, the machine, the vehicle that we're going to use to create this banking system, is a dividend-paying whole life insurance policy from a mutually owned insurance company. All right. So a dividend-paying whole life insurance policy from a mutually owned insurance company. Now, let me just clarify a couple things real fast on that. First off, this is not a standard, typical, off-the-shelf whole life insurance policy that you've probably ever seen before. What we do is we take that whole life insurance policy, we take a standard whole life insurance policy, and we chop it up and we hack it up. And we specially design and engineer it for being the bank and using it for the infinite banking concept. And by specially designing and engineering this thing, we can take a whole life policy that you might not get any advantage from for 4, 5, 6, 7, 10, 12, 15 years down the road. We can get full advantage of it starting immediately within 30 days. Like, it's so crazy. Now, for us to be able to do this, you do have to work with us. So I just want to make that clear. Like myself, our team, this is all we do all day, every day. Like if you want a standard insurance policy or some kind of term policy or IUL or VU or any of that other crap out there, like we're not the team for you. Like go to somebody else. And conversely, you can't just go to, someone in your networking group or a friend of yours or somebody from high school or a family member and have them do this for you either. 99.9% of insurance agents have no idea how to especially design and build a policy for this. And not only that, but once you have the policy, what do you do with it? How do you use it? And I'll talk more about that when we get to the marathon in just a second. But this is all we do all day, every day. So I want to make it very clear. If this resonates with you today and you want to get this started and implemented into your financial life, you're going to come to me and our team, our money mentors, to help you get this set up. So that way we can design it, we can consult with you, we can strategize with you, and we can design and engineer it specifically to fit your needs. Every single policy that we do is different. Every policy is different. Not any policy is the same. Every single one of them is customized for you specifically. So this is what our team does. Also, I want to make this clear. We don't charge for any of this stuff. So I have nothing to sell you today. This is all free. At the end, I'll invite you to schedule a call with myself or one of our money mentors so we can help you specially design and engineer this, but you don't ever pay us $1. The way we get paid is directly from those insurance companies, just like any other insurance agent out there. So we're licensed agents to be able to do this, and that's how we get paid. Now, because we give you all the advantages and benefits up front, and you can start taking advantage of it immediately, we also give up 60 to 80% of our commission. So we make a very reduced commission by creating, especially designing these for the concept, but nonetheless, that's how we get paid. And that's another reason why most agents either don't want to or don't know how to do this, because you go to an insurance agent and say, hey, you can create this policy for people and really help them in their financial lives, but you got to give up 80% of your livelihood. How many agents are going to do that? Not many, but we do a lot of business, a lot of repeat business. People come to us over and over and over again for more and more of these, not only for themselves, but for their families. Like I said, I started with one. I have 4 now. I'm working on my 5th later this year. So I think Chris has like 12 or 13. I think he's working on his 14th now. Brent Kessler's 24, 25 of them now. So you keep adding them as you grow. We'll talk more about that in a minute. Also, write this down: BOLI, bank-owned life insurance. Do you know who the #1 purchasers of whole life insurance in this country are? Yep, you guessed it right on the screen right there. Banks. Banks put over 90% of their M1 money supply into 2 different vehicles. #1, whole life insurance. #2, real estate. So you see, when we talk about becoming your own bank, why those are our 2 primary foundational strategies for being the bank? Because if banks are doing this, maybe we should too. Banks are taking advantage of it. Let's do that too. And then banks, I'm going to show you in just a second how banks make money. So let's go do that too. And they do a lot of it through real estate, not only buying real estate, but lending on real estate. And we'll talk about that in a second also. So do what the banks do, BOLI. Go Google that later though, bank-owned life insurance, and you can look all this stuff up. So who else buys whole life insurance policies and uses this in their financial lives? Well, there's actually a lot of people. Jim Harbaugh became the highest paid football coach in 2016. And a large portion of his compensation was in the form of whole life insurance policies, deferred comp plans using whole life. And actually, I just saw a recent article that he again became the highest paid coach in 2022, this last year, and they're continuing to give him more and more of these whole life policies, deferred comp. And we're seeing a lot of this with executives, with CEOs, with vice presidents of companies. We're seeing a lot more of this happening right now, where these companies are using whole life and deferred comp plans and company-owned policies to create these incredible incentive structures, incentive packages for their executives and the people they want to keep in their company. And we can mimic that for you too. If you have a company and you want to set something like that up for your key employees, for your executives, for yourself, let me know. I mean, we can do that for you also. We do it all the time. So just some examples here. Joe Biden has 6 of these policies. The politicians love them. Why? Because they're private, they're protected, they don't have to disclose them. They can put money in there and nobody knows what's going on. So many advantages. Walt Disney almost didn't start Disneyland. He had to tap into his whole life policies just to be able to continue the funding to keep the business going. Without this strategy, Disneyland might not even be in existence. Doris Christopher with the Pampered Chef, same thing. Ray Kroc, McDonald's, same thing. People like the JPs, the Morgans, the Chases, the Vanderbilts, the Rockefellers, they all use this exact same strategy in their families and their financial lives to be able to create wealth, not only today that they can control, but also generational wealth for generations to come. And the cool thing about all of this is you don't have to be wealthy. You don't have to be an uber successful person to implement this in your life. You can be living paycheck to paycheck right now, just barely saving a little bit, make one change, and we can use this strategy to drastically change what your future looks like. So just know you don't have to be super rich to implement this. And we'll talk about that as we get going here as well.
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris.
All right, so let's talk about how this machine works. What are we going to do to start mimicking the banks to make this machine work? So I want to talk a little bit about banking principles. All right, so these banking principles, how does this machine operate? And the best way for me to explain this is, let's first talk about how banks kind of make money. I'll give you a couple different examples here. So first question I have for everybody, can you make money earning 4% while paying 6%? Just put yes or no in the chat box. Can you make money earning 4% while paying 6%? What do you think? All right, Alexis says no. Jameis says no. Ajiva says yes. Shauna says depends. Mary says yes. Tony says it depends on the frequency of payment. Yolanda says yes. Okay, so we got some. Sean says F no. Okay. All right, so we got some yeses and nos. All right, so let me give you an example here of how this works. All right, so everybody's familiar with buying cars. So I'm going to give you a couple examples today on how we can use this buying cars. So for this example, let's just say that you want to buy a car, and let's say that car is $25,000. And you've been, and again, it doesn't matter if the car is 100 grand, 250 grand. This is just an example, just add a zero. And so let's say you want to buy a car for 25 grand. You've been saving your money for the last, I don't know, couple of years into a savings account. So now you got $25,000 saved in that savings account, and you're excited because you hit your goal and you're ready to go buy that car for 25 grand. So you go on down to your bank, you're all excited. You go into the bank, you walk up to the counter and you say, hi, I would like to withdraw $25,000. And what's going to happen first? Well, the teller's going to look at you and they're going to go, hold on, let me go get my manager. The manager is going to come over, and you know the manager, you can always tell who they are because they're the ones with the suit on, not a fancy suit. They don't make much money, but they got the suit on, the suit and tie. But more importantly, they got their little name badge. And what does the name badge have on it? They're a vice president, right? It's amazing how many vice presidents are at banks. But do you know why there's so many vice presidents at banks? It goes back to what I was talking about before with the BOLI, the bank-owned life insurance. By making that employee a vice president, it now makes him an executive, which gives the bank an insurable interest on that individual. And now that bank can buy a life insurance policy on them. So that's why they're all vice presidents. But nonetheless, that manager comes over in his nice suit with his name tagged with vice president, and he looks at you. And what's he going to say? Well, first off, he's going to say, you're going to have to come back next week because we don't have $25,000 sitting here, which how does a bank not have $25,000 cash? But I'm not making this up. Go to a bank and ask for 25 grand and see if they have it. We do it occasionally. My partners do it in real estate deals all the time to pay contractors and stuff. You end up having to go to like 10 different branch offices to get like 20 grand these days. It's nuts. But also, number two, even if they had the money, what else are they going to do? They're going to ask you why you need the money. And you can't just say, well, because it's my money. No. There's all these laws, right? Anti-money laundering. So you got to fill out a form, anything over $10,000, why you want it, what you're doing with it, all these questions. It's crazy. It's your money. Like, okay. But anyways, so let's just pretend none of that even happens. All right. So the banker looks at you, and this is what the banker does. All right. So the banker says, all right, so you have $25,000 in your savings account. And now I understand you want to take that money and you want to go buy a car. You're like, that's right. And the banker looks at you and goes, okay, well, listen, I'm going to offer you an alternative. So hear me out and let me know what you think. And so the vice president, the manager says, what we're going to do is we're going to take that $25,000 that you have in your savings account, and we're going to upgrade your savings account to a ultra super preferred premier savings account. Basically a magic savings account. Why is it magic? Ultra super preferred premier? Because instead of earning 0.07%, like the national average on savings accounts are right now, we're going to give you 4% return in that ultra super preferred premier savings account. You're like, well, shoot, that's pretty cool. Like 4% is way better than 0.07. And then the manager says, well, and then what we're going to do is we're going to allow you to use that savings account and the money in there as collateral. And what we'll do is we'll give you a loan for $25,000 so you can go buy the car that you've been saving for. So that way you don't lose your $25,000 in savings, and you can still go buy the car that you've been saving up to go buy. And you look at the manager and you go, all right, well, I get a magic savings account and I can still go buy my car and my $25,000 stays in my account. That sounds great. Well, what are the terms? Like, do I got to pay the loan back? Like, what's the rate that I got to pay the loan back? And the banker looks at you and they go, yeah, well, the car loan is for 6%. And you look at the banker and you say, you know what, Mr. Banker, I realize that there's a bowl of lollipops sitting on your counter right here. And the name on those lollipops, it's like this in every bank in the country, right? The name on the lollipops is what? Dum-dums, right? So you look at the manager like, I know you think I'm a dum-dum. You got a bowl of suckers. I'm not a sucker either. Bowl of sucker, dum-dum suckers sitting there. But even I know, I'm not a fancy banker. I don't have a suit on, but even I know that I'm not going to pay you 6% while you pay me 4%. The bank's, I'm going to lose money, right? And the banker looks at you and be like, no, hold on. Let me explain what's actually happening here. And you guys can check me on this, all right? You guys can check me on this if you have a financial calculator, but I've already done the math. All right, so here's what this happens. On that car note, what is going on at 6%? Well, a car note is over time. Typically, let's say 5 years, okay? 60 months, 5 years. That's a normal car note. And each month that you have that car note, what happens? You make a monthly payment towards that car note. So each month you're paying $483 to that loan. So what's happening with that loan balance each month? Well, it declines. So at the end of year one, you might owe only $22,000. And that's 6% on 22. And then the next year, the balance is lower. And then the balance is lower each year, each month and each year. So you end up paying interest on a smaller balance. This is what we call simple depreciating interest, the depreciating balance. But let's look what's going on over in our savings account. See, that savings account starts at that same $25,000. It's only 4% interest, but over those same 60 months, what is happening? Well, over those same 60 months, each year, the balance is increasing. So at the end of year one, you might have 26,500. At the end of year two, you might have 27,500. At the end of year three, you might have $29,000. You guys get where I'm going with this, right? So each year, the amount that you're getting paid the 4% on is higher each year. And so at the end of, when it's all said and done, at the end of the 5 years, your $25,000 in the savings account became just over $30,500, while the $25,000 at 6%, the same 5 years, became just under $29,000. So by listening to the banker paying 6% simple interest while earning 4% compounding interest, you would have just made a little over $1,500. And the reason I use this example and show you this right up front is because a lot of what we do with this concept is going to work off of this right here, making a spread and making simple versus compounding returns. Because within our whole life policy, all the money within there is going to compound uninterrupted, tax-free for the rest of your life. And then when we use the policy, the money comes out in the form of a loan. So when the money comes out, we pay the insurance company simple depreciating annual interest on any money that we're using. So at the end of the day, we're making a spread off of that money, and it gets stronger and stronger and stronger every single year that we have this banking system and this banking policy in place. And that's exactly what we're doing with this concept, is we're using that whole life policy as collateral to be able to use that money, just like in this example right here. The difference is, though, is that the spreads are much better because our money is growing at a rate greater than what we're loaning it out from the bank. So we're actually making a greater spread right from the start. But I'll come back to that in just a second. I don't want to get too far ahead of myself. All right. So how else do banks operate? Well, banks make money also off of what's called a spread. Okay. And what that means is if you take $100,000, you go to the bank and you deposit that $100,000 at the bank. Again, they don't have that money sitting there waiting for you to come get it. They take that money, they immediately start lending it out. So they find somebody that needs to buy a house. They give them a 30-year fixed mortgage at, let's say, 7%. They're paying you 4% in your savings account. So what are they doing? They're making a spread. A car note. Let's say it's an 8% car note, a 9% home remodel loan, a 12% debt consolidation loan. All these banks are doing is they're looking for opportunities to lend money so they can make a spread. So at the end of the day, they off your $100,000 that you're paying you 4% in this ultra premier super special savings account. They made 3% off the mortgage spread. They made 4% off the car note spread. They made 5% off the home remodel spread. They made 8% off the debt consolidation spread. So at the end of the day, they paid you 4%. They made 20% on your money. And in reality, they really made 500% off of the money that you leave sitting at their bank. You see, if they're paying you 4%, and they're making 20% off that money, that's a 5x return. That's a 500% return that the bank is making off of money that you leave sitting there in your checking and savings accounts. And if you don't believe me, again, double check this stuff, write this down. There's a website called BauerFinancial.com, Bauer Financial. And Bauer Financial is a bank research agency. And this is all they do is they research banks and how they profit and what they do. And Bauer Financial tells us that banks make between 400 and 1,300% off money that we leave there. Why are we making the banks rich and not enriching our own financial lives? And that's exactly why we're here right now today, to become the bank and start doing this exact same thing in our own financial lives. So how do we start doing this? Well, to start doing this, we really just need to make one change. So let me show you what that one change looks like in reality. So if I was to take a dollar bill today and I was to break that dollar down into how an average American spends that dollar when they earn it, this is what that would look like. It might vary slightly for you and whatnot, but on average, this is what this looks like. So if we take a dollar, 20 cents of every dollar earned goes to an automobile in one way or another. Payments, gas, upkeep, lost interest if you buy it cash, insurance, whatever. 30 cents of every dollar that we earn goes to housing. 40 cents of every dollar that we earn goes to everything else. So things like kids, travel, entertainment, food, whatever the case is, which leaves us at the end of the day with 10 cents that goes into our savings, the leftovers. And right now in this economy, that 10 cents is shrinking very, very fast. During the COVID and all the money printing and money pumping into the economy, savings went up. Right now, savings are drastically dropping. People are tapping into their 401ks in record amounts. People's credit card balances as a country, we just went over $1 trillion, a record high for the first time in the United States history, over $1 trillion in credit card debt, and savings are getting demolished right now. One of the reasons savings are getting demolished right now is because of inflation. Inflation kills savers. Why? Because of inflation's right now at 3.2, which is, we all kind of feel like it's a little higher than that. Let's just say 3.2 right now. The bank's paying you 0.07% on a national average in a savings account. You're losing money right now, right? So, but even at the end of the day, they'll forget all the rest of that right there. 10 cents goes into savings, all right? So what we want to do is we want to make one change, and that's where our money goes first. So instead of paying everybody else all of this first, let's go ahead and take that 10 cents, that 10%, and let's put that into our own banking system. So let's look at what that would look like if we were to make that one change. So now when we earn every dollar that we earn, we're immediately going to take 10% and put it into our own banking system. By making that one change, we now can use our own banking system instead of somebody else's banking system to make purchases and do things in life, such as buying cars. So watch this. If we look at, on average, of the 20 cents that goes to an automobile of the dollar, 5 of that 20 cents, 5 cents of that 20 cents goes to interest to somebody else's bank. But by being the bank and purchasing that automobile with our own bank, now what we can do is we can pay that interest back to ourselves. And by making that one change right there, paying ourselves first and using our own bank instead of somebody else's, we're able to increase our annual savings by 50%. Think about it. If we were saving 10 cents before, and now by changing one thing, we're now able to save 15 cents a year, that is a 50% increase. Imagine that year after year after year after year after year, how much more savings you're going to have. And not only with automobiles does that work, but what else? How about with housing? Did you know of the 30 cents out of 100 cents that goes to housing, 25 of that 30 cents goes to interest? Well, how is it so high? Well, if you've ever looked at an amortization schedule, like a 30-year fixed rate mortgage, about 70 to 90% of that interest is paid to the bank in the first 7 to 10 years. On average, people move in this country every 7 years, When you move, you have to get a new mortgage. There's a due on sale clause, or people refinance. When you refinance, it starts things over again. Banks are getting their money in the first 7 years, so they don't care what happens. They encourage people to move more often, refinance more often, teaser rates. The markets are always going up and down. Why? Because they encourage that, because they're getting their money up front. So 25 of every 30 cents on average goes to interest. So what if we were to now buy real estate with our own bank? How much would that increase our annual savings from money that was bleeding out to the banks? And then if we do it with everything else, on average, 5 cents of 40 cents. Again, that's higher now as credit card use is going up and rates are going up. But on average, 5 out of 40 cents goes to interest. So while we're at it, why not just recapture that money as well? So now by making one change, becoming the bank, paying ourselves first, making ourselves important, and using our own banking system, not working any harder, not working any longer, not taking on any more risk. We just increased our annual savings from 10% to 45%, just like that. Now, what can we do with all that extra money that's in our savings, in our new banking system? Yes, we can put that money out to work to do what? Make more money, keep that money in motion. And I'll show you that in just a second. All right. So let me show you some examples of how that works in the real world. So the first one I want to show you is sticking with that car example. How would you like if you could get back every single dollar for every car you'll ever buy, drive, and own in the future? You guys want to know how to do that? Let me show you how this works in the real world. All right. And as I start to show you these examples, I'm also going to start teaching you. I want you to really understand how these policies work and some of the basics. So then when you hop on a call with one of our money mentors later this week or next week, you already know how this is going to work, and we can focus more on your situation personally, what you have going on, how this can work in your personal financial situation for you and your family. And we don't have to talk about the basics of these policies. I'm going to teach you that right now as I show you these examples. So if we look at this machine, let's take a quick look under the hood of it. So on the right here, we have what we would call an illustration. So over on the right side is the death benefit. That's what gets paid out tax-free if you meet your demise. And as we like to say, graduate, pass away. Now we don't do this for death benefit, but it's a nice little cherry on top knowing it exists. But over here, right here, we have the policy year, we have the age of the individual, we have the amount going into the policy. Notice these are what we call deposits. I'll come back to that in just a second. And by the way, you decide how much you put into this thing. And then the rest of this, I'll show you on how we buy cars in just a second. So when it comes to the deposits going into this policy, this whole life insurance policy, are actually the policy premiums. Now, from this point forward, I'm going to challenge everybody that's on here. I never want you to call these whole life premiums again. I want you to call them your banking system or your banking policy deposits. So when you put money into this thing, whether it's monthly, quarterly, biannually, or all up front each year, you choose that. It's up to you on how the money gets in there. You also choose how much you want to put in there, whether it's $5,000 a year, 10 grand a year, 100 grand a year, $1 million a year, whatever it is. We'll talk about that is right for you. Whatever that amount is, I want you to think of it as deposits from this point forward. Why? Mindset. I talked about it at the beginning. A lot of this is a mindset shift. When we think about premiums, health insurance premiums, car insurance premiums, homeowners insurance premiums, it's a negative. It's a bill. It's an expense. It's something I don't want to have to do. But if I go and I do a real estate deal or I get a nice flip done or wholesale deal or something, and I have 10, 20, 30, $50,000 check sitting there, I'm excited to go deposit that in my business account at the bank. I'm excited to go put that into my savings account. Well, would it not make sense for me to be excited to go deposit this into my new banking policy as well? 100%, right? So these little things are going to really help with the mindset aspect of this. So from this point moving forward, when we pay into a policy and we fund a policy, it's not a premium, it's a deposit. Age does not matter. We start policies for 2-week-olds, 2-year-olds, 20-year-olds, 30-year-olds, 50-year-olds, 60-year-olds, people into their 70s. Now, if you're older than that, or maybe you're just not really healthy, something's happened where you know you can't get a life insurance policy for whatever reason, We do have solutions for that as well. So just ask us about that on the phone. You can still use this strategy and be the bank. We would just have to use somebody else's life for a policy. So we could talk about that, but just know age does not matter. And again, the death benefit is kind of the sugar on top. All right, so let's get into this. So here's how this works. Let's say that this individual, 26-year-old individual, they started their banking system and they decided they wanted to put $10,000 a year into it. Well, in the third year of that thing, they decide that they want to buy a car. So this column right here, anytime you see cash value, in this case, cash value in the money multiplier account, the cash value is the amount of money as you deposit money into it. And as the money in there grows for you, the cash value is the amount that you have available to pull out to use. Okay. In this case, we're going to use the money to buy a car. So in the third year of this thing, this individual decided they wanted to buy a $25,000 car. Now, again, the amount of money doesn't matter. My buddy Devin Burr, Mr. Burr on Instagram, go check him out if you don't already follow him, or on TikTok, Mr._Burr, which, by the way, he's flying to Florida right now. I'm going to see him tomorrow. So super excited about that. But nonetheless, Mr. Burr just did this and he's got some videos on it, how he bought his new Audi R10 for, it was like a $200-some-thousand car. So this will work no matter the cost. I just wanted to kind of use this as a simple example. All right. So $25,000 car is purchased in the third year. Now, just like before, where the banker used the savings account as collateral and gave you the loan to go buy the car, same thing is happening here. What we're using is the insurance company is using your death benefit as collateral, and they're giving you the money to be able to go buy that car. Okay. So watch what's going to happen here. So that $25,000 comes out of the policy. And then just like if we were to borrow the money from someone else's bank, when we borrow the money from our bank, we're going to be an honest banker and we're going to pay ourselves back. So in this case, we set up a $500 a month repayment plan. So over 5 years. So over the next 5 years, just like any other car note, I'm going to pay my bank back $500 a month. So what does that look like? So over the first 7 years, we put $70,000 in premium deposits. We took $25,000 out to buy a car, and we recaptured and paid ourselves back $30,000. We pay ourselves back with interest, just like we would pay a bank interest. All right. And at the end of all that is said and done, we put $75,000 into the policy. And how much do we have sitting here in our account? $67,000. Plus we have the car free and clear paid for sitting in our driveway. So if I did my math here, I just recaptured 91 cents of every dollar over that 7-year time span. Buying that car, I've now recaptured back into my banking system. But before I told you, I'd show you how to recapture 100%, not just 91%. So let me show you, because this doesn't stop in 7 years. This is a whole life policy. So this money is going to grow for the rest of your life. Now, in reality, you would never want to stop making premium deposits into this thing, because every year you have it, it becomes more and more efficient. And I'll show you that in just a second. But just for the simplicity of this example, what would happen if after 7 years, I never put another dollar into this policy, but I continue to use it to do things like buy vehicles? Well, let's say in the 8th year of this thing, I stop making premium deposits, but I go and I buy another $25,000 car using the death benefit, using the policy as collateral. What does that look like? Well, over the next 5 years, same thing. I'm going to be an honest banker and I'm going to recapture my money. So I put no new premium deposits in. I took $25,000 out. I recaptured $30,000 for a net of $5,000. So what happened here? Our account, our banking policy, banking system went from $67,000 over the 5-year time span to just over $91,000. So it grew by over $23,000. But remember, I made no new premium deposits and I only recaptured $5,000 in interest. So how did that policy grow by over $23,000? Well, because all of this money that you're putting into this policy is going to compound uninterrupted, tax-free, guaranteed for the rest of your life, no matter what else is happening. Even when you pull the money out of this thing, all of that money still sits in there compounding and growing every year for the rest of your life, uninterrupted compounding interest. And that's what allows us to have two $25,000 cars sitting in our driveway equaling $50,000 free and clear. and $91,000 in our account, and we only net injected $80,000 over that 12-year time span. Plain and simple. And if this works for cars, what else can it work for? Now, I will say, to make this work, you do have to follow the 3 rules of what I call being an honest banker. Rule number 1, change the one thing, where your money goes first. So always pay yourself first. Rule number 2, always pay yourself with interest. Treat your money like you would the bank's money. If you were to pay the bank interest on something, pay yourself interest when you use your banking policy. And number 3, always recycle and recapture your money. See, here's the difference. If I was to finance a car through BMW or Ally Financial, and in the 3rd year, I couldn't make my, I fall on some hard financial times and I couldn't make my monthly payments for that car note, what is going to happen? Well, BMW is going to send a big gruffy guy with a beard and a tow truck to take my car from me. They're going to repo that thing. Well, here's the difference. If I take a loan from my banking policy and something happens in 2-3 years, whatever, and I can't pay myself back, what's going to happen? Well, I'm going to go to the mirror and I'm going to say, hey, Steven, hey, I know I borrowed money from your bank, but I fell into some hard financial times and I can't pay you for the next, 6 to 12 months, maybe longer. And I'm going to look in the reflection of the mirror is going to look back at me and say, you know what, Steven, you're a really good guy. I really like you. Like, I have no problem with this. Like, just start paying me back whenever you want. Like, it's up to you. And I'm going to look in the mirror and I'm going to say, thank you very much. And I joke about that, but the reason I bring it up is why? It's because you're in complete control. This is your banking system. So when you borrow the money from the policy and you use it for whatever you're using it for, purchases, investing, paying off debt, whatever, you are in complete control of that loan, of taking the money from the policy. So how and when, or even if you ever pay it back, it doesn't matter. You're in complete control. It's up to you. See, the insurance company knows they're going to pay that death benefit out one way or another anyways in the future. So if you're using it now or later, they don't care. So that's it. You're in complete control. So you decide. Now, we will always encourage you to be an honest banker, treat your money like you do the bank's money. So always pay yourself back and follow these 3 rules. But at the end of the day, you are in complete control. And I just want to make that very, very clear. So what else do you buy? Boats, airplanes, what other major purchases? A new roof on a house? I'm getting ready to do that right now. New appliances? I just used the policy to buy a new stove a couple months ago. We can use this for anything and everything in our financial lives. All right, so a couple more another example of the marathon. How about paying off debt faster while still building wealth? Anybody have any debt on here? Any debt? Anybody with debt? Watch this. This is going to blow your mind. If you really want to snowball and pay off debt, watch this. So this was a chiropractor. This was about 10 years ago. This is a real case study, though. This chiropractor made great money. Just like a lot of people that make great money, they're not always the smartest with money. They make money, they spend money, and then all of a sudden, this chiropractor said, holy cow, I have $478,000 in third-party debt. And we added it up. He was paying $5,777 a month to third-party debtors, almost $70,000 a year he was making in payments to all these third-party debtors. Why? Because he had a few credit cards, he had a private loan for some things he was doing for fun. He bought a BMW, he bought a boat, he bought a beach house condo, plus he had his mortgage. So all this stuff adds up. And so $478,000 in debt. And we did the math. If he was continue paying it the way he was, it would take him 19 years to pay off all that debt. So let me show you how we use the infinite banking concept and the specially designed whole life insurance policy to do this a lot faster while still building wealth. Watch this. So year one, this chiropractor decided to start a policy putting $25,000 a year into premiums. Again, what are those premiums called? The deposits. Okay. Now, when he puts that $25,000 in, he has a little under $15,000 to pull back out. Now, I mentioned before, this case study was from about 10 years ago. Well, a couple of years ago, there were some changes made in the insurance industry by the IRS and by the federal government, known as the 7702 rules, which affect how these things are regulated and how insurance policies operate, what's known as the MEC rules. And when those rules changed, we were scared that it was going to make what we do impossible. It was going to change the way life insurance worked. Well, lo and behold, it actually gave us more advantages. Why? Because I think the wealthy, the politicians, they all use this stuff. So of course, they're not going to change the rules to make it a hindrance on what they're doing. They're going to make it better for themselves. So we now can take advantage of that. So when we build policies now, especially if you're a real estate investor, you want really high cash. I mean, if we do it right, we can get you like access to like 90% of what you put in year one to be able to pull back out to use. I think this is probably around 60%, which is great being able to pull 60 out. But if you want real high cash, just talk with us. We can design that for you now. It's really, really cool stuff. But I leave this example here because under promise, over deliver. If it works for this, imagine what it could do with one of these newer policies. So check this out. 25,000 goes in, 14,000 available to pull out and use. So that's exactly what we do. We take that $14,800, we pay off the Discover, we pay off the Lowe's, we pay down the Nordstrom rack. Now, what does that do? The $5,777 that was going to third-party debtors is now down because we eliminated those monthly payments to $5,329. Now we have $448 that's no longer going to third-party debtors. But what are we going to do with that $448 that was going to them? What we're going to do is we're going to take that $448 a month and we're going to pay us, our banking system, instead of Discover and Lowe's banks. So now, and the way we do that is we're going to teach you to set up what's called a segregated bank account, or just a separate checking account. So when you pull money from the policy, we can take that money and we can deploy it to do things like buy a car or pay down debt or whatever. And then as we recapture that money, goes back into that segregated separate checking account where it builds in there. And then from there, we can either put it back into the policy or we can keep using it like you're going to see in this example right here. So again, teaching you as I show you these examples, we're going to show you how to set up this segregated separate bank account so you can do this stuff with it, okay? So now what we have is $5,329 a month going to third-party debtors, and we have $448 a month going to our banking system into that segregated bank account. So after the first year is completed, year two starts, $25,000 goes into the policy. We have $16,500 now available to pull out to use. And you'll notice the first year is $14,000, the second year is $16,000, the third year it'll be higher, the fourth year it'll be higher, the fifth year it'll be higher. It gets bigger and bigger every single year for the rest of your life because of that uninterrupted compounding returns within the policy. So in the second year, we have $16,000 in cash value to pull out, as well as the $5,374 we can use. What is that? That's $448 a month over 12 months into our segregated account. That's that $5,374 for a total of just under $22,000 that we can use to pay off the Nordstrom, the Wells Fargo, the private loan, and pay down the BMW. So now we have $3,860 going to third-party debtors and $1,917 a month going to our banking system. Year three, 25,000 goes in, a little over 25,000 available, 23,000 in the recaptured monthly payments, a total of 48 grand to pay off the BMW, pay off the West Marine boat, and pay down the condo. 2,100 going to third-party debtors, 3,600 coming back into our financial system. Now, let me make sure you're following before I go any further and show you this. How does this marathon work? Well, so far in the first 3 years, we have put a total of $75,000 into the policy. And each year we've pulled money out of the policy, $14,000 the first year, $16,000 the second year, $25,000 the third year, for a total of $55,000. So if we put $75,000 in, we pulled $55,000 out to use to pay off debt. How much is left in the policy? What do you think? How much is left in the policy? $20,000? Nope, $75,000. Now, how is that possible? Well, because we put the $75,000 in, but remember, when we pull this money out to use it, it comes out in the form of a loan. Remember, the insurance company is using your policy and the death benefit as collateral to give you access to that money to use. And because it comes out in the form of a loan, not only is it tax-free when it comes out, but it allows all that $75,000 to remain in the policy, compounding and growing uninterrupted for the rest of your life. Plain and simple, right? Year 4, 25,000 goes in, 26,000 available, 44,000, 70 in cash. Pay down the condo. Year 5, same thing. Pay off the condo, pay down the house. Now look what happens in year 6. This is important. In year 6, you'll notice that we can only put $10,000 into this first policy. You see, because of the MEC rules and regulations and the IRS rules, at some point in the future, you're going to be required to reduce the amount of premium deposits you're putting into that policy. Now, in today's policies, that's typically going to happen in the 11th year. So you can put the larger amount in for the first 10 years, and then in the 11th year, it's going to drop. In this case, it was the 6th year. So what this chiropractor said was, hey, like, this is awesome. I love being my own bank. I don't want to put less money into my banking system, my banking policy. I want to put more money into it. So because of the rules, we can't put more than $10,000 a year now into that existing first policy. So what can we do? You got it, Tony. We can open up additional policies. So you can open up additional policies on yourself, on your spouse, on your kids, on business partners. You can start stacking these policies, many as you can qualify for, to start building your banking system. That's exactly how this works. So he started a second policy, putting another $25,000 in for a total of $35,000 a year. But look at that first one. He puts $10,000 into it. The policy grew by over $13,000. That's a 30% tax-free cash on cash return. Remember that ATM machine I told you about earlier? You put 10 grand in and the next year you can pull 12 grand out. This is this. In the 6th year of this banking system, you have this ATM machine where you go put $10,000 in. The next day, you go pull $13,000 back out. Guess what happens in the 7th year? Put $10,000 in, go pull $14,000 back out. That's that ATM machine I was telling you about. So what does this look like? We now have $82,000 in the 6th year of this process. We've now eliminated all $470,000 in third-party debt is gone. All that interest that was bleeding to all these other banks from his financial life is gone. And what this chiropractor now does is takes that $57.77 a month, continues to put it into a segregated account, back into the policy. And then once the debt is gone, guess what happens then? That's where we get to start talking about the millionaire, because that's where we get to start having some fun with this. But before I get there, I just want to be clear. What I just showed you, paying down debt like that, we are going to do that for you as well. Okay. I mentioned before, we don't charge $1 for any of this stuff, for consulting with you, strategizing with, helping you, holding your hand, creating, designing, engineering these policies, helping you get approved. Not only there though, but even once you start the policy, once it goes in force, even afterwards, we have what's called our mapping implementation team. And they're going to meet with you immediately, say, hey, what do you want to do with this new banking policy? And you're going to say, hey, I have some debt I want to pay off. They're going to do a cash flow analysis, and they're going to create what's called a debt map for you, for your situation, on your cash flow, your new banking policy, on your debts, and they're going to create that plan of action. And then they're going to reach out to you every 3 to 4 months to check on you. Are you staying on plan? Do we need to change anything? How's it looking? And if something happens before 3 to 4 months, you just schedule a call. We're right there for you every single step along the way. So not only do we set this up for you, but we help you and hold your hand for years and years and years and years, as long as you have this policy. And we're in business. We've been doing this for over a decade already. We're going nowhere. We're one of the largest companies in the entire country, and we have more success than anybody else out there in doing this. And a large part of that is due to the support, the training, and the hand-holding that we do for all of our clients at zero cost. All right. So if you guys like that right there, we will set that up for you as well. I like to call it, this is our mapping implementation team. I like to call it a financial GPS. And it doesn't stop there as well. Once you have this policy set up, our BYOB blueprint specialists are going to talk to you about other financial areas of your life. Like, where else are we bleeding money out? How else can we save on the wealth killers, eliminate taxes, eliminate volatility, take back control of our retirement dollars? All of this stuff we can talk to you about through our BYOB blueprint specialist. So we can dig into other areas of your financial life. So just things to look forward to in the future. So when we come to the millionaire, again, if you don't have any more bad debt, or once it's paid off, maybe you don't have any major purchases, should you still do privatized banking? Should you still start your own bank? Yeah, man. That's where the fun begins. This is what I'm doing now. This is what Sean is doing now. This is what Chris is doing now. We're using our policies to build wealth outside of every now and then buying a new car or a roof or something like that. But most of the money is going now into investments and growing wealth. And this is where it becomes really, really fun. These are some of the different ways that we're building wealth right now. However you invest, our recommendation is you need to know it, you need to understand it, you need to like it. If you know it, like it, and understand it, probably a good idea. So these are all things over the last 10 to 15 years I've learned and things that I invest in, from active to passive real estate. I'm just starting to learn about notes with Kevin. Crypto, I played that game a little bit, not right now. Just started flipping forklifts, which is pretty cool stuff. But this is all stuff we talk about in money school and our 3-day money school essentials trainings and stuff like that. So just different ways that we can use these policies. Wanted to throw some examples out there. All right. So I want to show you, talk about the millionaire for just a second, because again, when we have this policy, we're taking advantage of the 2 laws for creating growing wealth. By putting our money in here, we're taking advantage of uninterrupted compounding interest. Again, it's tax-free and it's guaranteed. And that's one of the rules for creating wealth, is taking advantage of compounding interest. Number 2, money movement and money flow. So that's what I'm going to get to, because again, simultaneously, while the money's in there compounding, we can take it out, invest it, and grow our wealth, keep the money moving and making more money for us. So let me show you what this looks like in the real world. So here's a policy. This is one I started for a young lady. She was 40 years old last year, 41 years old now. $150,000 win in the first year. Now you'll notice on here, she's doing $50,000 a year. That's what she was comfortable putting into her banking policy. But she had more money right now. So she was like, hey, I want to put more money in up front, but I only want to do $50,000 a year moving forward. So that's what we designed for. Again, we can customize this almost any way that you want. Just ask us. So in this case, she put $150,000 in first year. Look how much is available over there. You see the cash value? Again, the cash value is how much is available for loans. $132,000 in the first year of the 150. That's about 90%. High cash. She can take that and go do more real estate deals. But in this case, let me give you an example. Let's say she starts this policy. She's doing a lot of active real estate. And in the 8th year of this, she wants to become a private money lender. So what happens in the 8th year of this policy? Well, in the 8th year of this policy, it grows by $66,000. That's the growth in the cash value. Okay. Grows by $66,000. To get that growth, she has to inject $48,000 in premium deposits into it. So that's a $18,000 in growth, or a 37% cash on cash return. Remember that ATM machine again, in the 8th year of having this banking system, her ATM machine just paid her $18,000, or a 37% cash on cash return. When she wouldn't put that money in the ATM machine, gave her a 37% return right away. So what happens? Let's say she wants to do a private money loan. Very common right now for private money loans are 12%, which, are there any borrowers, any active real estate investors on here right now? Do any of you have a deal that you would be willing to pay me 12% interest if I was to give you the money to fund that entire deal? Would anybody on here right now be willing to pay 12% to me? I guarantee you there's a bunch of people on here that would be willing to do that. So what does this look like? So if I was to do this loan using my policy, let's see what that looks like that year. Well, I would make 12% on the private money loan that year. My banking policy grew by 37%. To use the money in the policy to do that private money loan, I had to pay the bank 5% interest. So if I net that out, I made a 44% return. So let's look at the alternative real fast. Using my banking system, I made 44% that year doing a private money loan. If I would have taken money from my Wells Fargo checking account or savings account or business account and done a 12% private money loan, how much money would I have made? 12%. What did I do different? absolutely nothing except changed one thing 8 years prior, and that's where my money went first. My money started going into my own banking system instead of somebody else's banking system. And by making that one change right there, I was able to earn 44% of my money that year instead of just 12%. And at the end of the day, by making that one change, it really is that simple. Here's another policy. This was a young person, 37 years old. They were comfortable saving, putting away $500 a month into this policy. So a little under $6,000 a year. I mean, how many of you could do $500 a month? But they had just done a deal and they had some savings sitting there. And so what they did is they dumped in $50,000 up front, knowing that they could immediately turn around and go borrow back out almost all of that $50,000 to go do another deal. But what does it do? It gets that 50 grand in there and starts that uninterrupted compounding tax-free guaranteed growth on that 50 grand for the rest of their lives, even while they immediately take most of it right back out to use it for the next real estate deal. So then they start doing $500 a month. I mean, look at these returns. In the 10th year of this thing, a 54% return, the 5th year, 26%, 20th year, almost a 200% return. Just mind-blowing stuff. So this is what this looks like visually speaking. You have your money multiplier banking policy. You take a loan, it goes into that segregated account. Then what we do is we lend the money out to somebody on a real estate deal, for example. We do a lot of this, by the way, through Private Money Club. If you're not aware of it, it's a platform for real estate borrowers and lenders that are looking for deals, looking for opportunity, looking for ways to move their money. It connects them, provides the education, provides the platform, the coaching, everything you would need to do successful deals like this is part of Private Money Club. And so we lend the money out at 12%. We start getting monthly payments. We keep the spread. We put the rest back into the policy so we can do it again and again and again and again. So just a real quick little visual on what that looks like. So again, this is Private Money Club. I'll put some links in just a second. We have some coaching programs. We have some discounts available for our coachings. And by the way, if you're an active investor, we actually have a Private Money Club performance coaching bus tour. It's an in-person event in Georgia coming up just next month, in the middle of September, where we're going to spend 2 days going out into the field and digging into an actual real estate investment business with Mike Puglisi and Mike Oborn. We're going to dig into their business, how it works, what they do, how they get business, how they work with contractors, property managers. You're going to go on a bus into the field and look at properties, 3 different properties, one at the beginning phase, one that's being already worked on, and one that's at the end. It's going to be a really, 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 really cool 2-day bus tour coaching program. And then we do some support ahead of time, some calls ahead, some calls after. So just ask us about any of this stuff. If you want to learn, I'll put the link in just a second on how you can schedule a call to learn more about that and get some discounts. All right, I know I'm over, so let me just wrap on this slide right here. I just want to make sure I didn't forget anything. So again, the loans never have to be repaid. You set the terms. You're in complete control. The internal growth is all tax-free. The death benefit goes out tax-free to your loved ones, creates a legacy. These policies are protected. So in most states, they're exempt from judgments, liens, lawsuits, things of that nature, protected. You can use them for business. So we can talk about company-owned life insurance policies. We can talk about using a personal policy to lend to our LLC, to lend to our business, so we can use it that way. I can teach you all that stuff. We just don't have time right now. Kids policies, using it for college, for buying cars, for maybe their business down the road, things like that. So kids policies are super powerful. And again, you decide how much you fund with. So last 2 questions. Are you better off with one of these policies today when you're alive, creating a banking system in your own ATM machines? And are you better off with or without one of these once you do graduate and pass off? If the answer to those questions is yes, you feel like you're better off with this, then we would love to talk with you. So the way that we do this is we set up a call. So if you want to talk about your personal situation, what the right funding amount is for you, how you can implement this into your financial life, you're going to go to this right here, moneyschoolrei.com/events, put in your name, email, and phone, and you could schedule a call either with myself or my team on the round robin. Just let them know you're on today's webinar. All right, with that being said, guys, that's all I have for you here this Wednesday. Thanks for sticking with me. I know we went a little bit longer. the normal, but I wanted to make sure that we hit everything that you would need to know to start learning the basics to become the bank and use the infinite banking concept in your life. So if you have any questions, throw them in the Q&A box and I'll hit those for you right now. So Alex said, can we get more info on Tampa Mastermind? So Alex, next in September, it's an invite only mastermind called Family Mastermind. So I would need to know a little bit more about your business and what you do to see if it'd be right for you. It's not a mastermind that we put on. Our mastermind that we hold 3 times a year is called The Experience. And that one's in October out in Las Vegas. So if you want, and we do have 3 tickets left for that one. So if you want to attend the mastermind with our entire team out in Vegas and just have some incredible experiences, that's why it's called The Experience. I can post a link for that also. Okay, so you can go right here to check out The Experience. And if you have any questions, just email Shauna at chrisnaugle.com. And she can help you out with anything you need on The Experience. But yeah, I'll be out there. Our whole team will be out there. We have a great time at The Experience and would love to see you all there as well. Kel said, is the current interest charge for doing a loan through this whole life policy set up? Yeah, it's a little less than 5% right now annual, and it's simple interest. So if you take a $10,000 loan and keep it out for the entire 12 months, it's $500 in interest you would pay at the end of the year. If you have it out for 6 months, it'd be $250. If you're paying it back throughout the year, it's going to be a little like around $280 or so, whatever that math rounds out to be, but it's calculated daily. It's simple annual interest. It can vary, it's variable, but it usually moves very slowly, if at all. So it's been around that like a little less than 5% range, depending on the company for a long time now. So I know this is an example, but just wondering what today's interest charged. Also, what is interest earned on cash? Yeah, so the policy money compounds through the company's annual dividends, which right now are around 5.5%. So the money's compounding at around 5.5. You're paying around 5, so you're making that little spread. But again, we're looking at the simple depreciating interest versus the uninterrupted compounding. So you're making that small spread, positive spread the first year, but every year that you have the policy, just the spread becomes more and more and more and more. If you think about the ATM machine, like in the example where you put in $10,000 in the 6th year and pull 13,000 back out, that's a 30% spread. So if you're making 30% and you're paying 5%, it's kind of irrelevant. So after that first year, it's just all kind of gravy, so to say, Kel. And again, the dividends can vary as well. They're not guaranteed per se, but the companies we use have been paying consistent dividends for over 200 years. And the companies we use are financially doing better than they ever have. They're having record payouts. So we expect to see those dividends stay strong and probably increase as interest rates increase. Historically, they tend to kind of track treasuries a little bit. So right now that we're seeing treasury yields increase, there's a great chance that dividends will increase because that's how insurance companies invest a lot in long-term, very conservative stuff like corporate bonds and US Treasury. So as we see those yields increase, we should see profits for the insurance companies increase, and that probably will affect dividends. And that's the other thing with the loan rate also. If they increase the loan rate, that's just more interest going to the company's profits. So usually that ends up with a higher dividend rate as well. So when we're using it, those spreads usually tend to stay pretty close, Kel. So really good question, though. Thanks for asking it. Tony said, what is the interest rate? Yeah, same thing, Tony, like I just said. Let's see here. Yeah, so the download link to get those books, it is on that moneyschoolrei.com. I'll put it in the link so you guys can just click it in the chat box. But if you just put in your name, email, and phone number, you can immediately download all 3 books and then also get access to the resources and the weekly webinars. So there you go. Just put that right in just click that link right there in the chat box, and you can get all those if you don't already have them. And then NagyLeadership.com just forwards to my, what's it called? Link tree, I believe. But my contact information is all on there. You can download my contact card for your phone. And then there's some presentations and stuff on there, different resources as well. And if anybody needs me for anything, feel free to text or email me. Otherwise, definitely schedule a call with one of my money mentors so they can help you get this policy started. Let's see. How difficult is it to change policies, companies? Troy, so it depends on the policy, but if the situation was right, you can do what's called a 1035 exchange, which would exchange the cash value in one policy over to a new policy at a new company. If it's a term policy, we might be able to convert it. So it just kind of depends. Johnny said, is Florida exempt from liens? Yeah, the policies are protected in Florida. It's one of the reasons why, I hate to bring this up kind of, but OJ Simpson, OJ Simpson, one of the reasons he's still a multi-millionaire is because of his asset protection. And a lot of that is done through life insurance policies. And it's one of the reasons he lives in Florida. Johnny, no, none of the money triggers taxes. The money goes into the policy after tax, and then all the growth within it is tax-free. When you take the loans, it's not reported anywhere. Nobody asks you why you're taking a loan or what you're using it for. So it's unreported, it's undisclosed, and it's tax-free. And then any profit you make when the money's outside, like in a real estate deal, of course that's taxed, but at the same time, if you have everything else set up properly, we should really be able to minimize and reduce those taxes if done the right way. So all of this works hand in hand in conjunction with each other. Tony, they can be reduced, but they cannot be increased. At that point, you'd have to start new policies. All right, cool. So if anybody has any future questions, right as I say that, people are putting questions. All right, last one. When you noted we don't have to repay the loan, how does that affect the policy? It doesn't. As long as you're keeping up with the interest you need to pay. If you have the policy start paying the interest, which I would recommend in later years, not the early years, but otherwise it's uninterrupted. It's uninterrupted compounding growth. So whether you're repaying them or not, but we'll always encourage you to repay them because that's being an honest banker. But if you want to ask any other questions or anything, join us at 4:30 for what's called the Ask Me Anything Happy Hour, where we go live on the YouTube channel as well as our Facebook pages. So if you're not already, go on at the Chris Naugle on YouTube or at Private Money Club on YouTube, or follow myself or Chris or any of our Facebook groups, and we live stream the Ask Me Anything every Wednesday at 4:30. So hop on, ask the rest of your questions. If anybody needs me, email me or text me. I appreciate everybody being on today. Thank you. And we will see you guys soon. Have a great one. Bye.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.